Good morning, Richard. It seems like the rise in interest rates that's been going on for the last year, anything that we should be considering looking for over the coming weeks, even coming months?
Corporate debt culture was predicated upon zero interest rates. And now they're 5%. That massive jump, when we've only felt half of it. I mean, because it takes 9 or even 12 months to actually be in effect in your economy, we've felt maybe 2.5 of 5%. And that 5% could end up being 6%. That your economy contracts like day follows night. It's going to happen. And it is in process if you look at the leading economic indicators. But it's a huge increase. Now, by the way, on the flip side, that does offer opportunity. Right now, you can get 5% on short to intermediate term, very safe investments, which is a heck of a lot better than it was, for years.
Could you kind of define the tactical allocation portfolio, so we kind of get a definition of it?
Within a certain risk-controlled environment, you're looking for the best opportunities you can possibly find. And those just so happen to appear when markets get the craziest, if you're ready for it in advance.
What's the kind of the rationale of how you've got the assets positioned right now?
Okay, let me show you by sharing the screen. So in the month of January, the Wasatch Hoisington, that's 19-year long US government bonds, that's a highly volatile asset class. It went up 6.5% in January. I had purchased it in November to offset losses that were occurring in managed futures.
Mm-hmm.
That's the biggest category down here on the bottom, which was 43%. Now in January, managed futures had stopped falling, but treasury bonds were still doing great and the long ones really great. So we did fine, mostly because of those long bonds. Now the next chart shows from February 1st until yesterday, which is the 7th. March 7th. Well, look at this. Treasury bonds went down 5.31%. We, however, went from 17% in treasuries to 4.38. Mm-hmm. And what we did was we added to this market neutral fund here called Federated Hermes Market Neutral. That fund is up 4.95% so far this year. It was just up 9.5% last year. It's a good fund. It's a good diversifier for our other equity long short fund, Hussman Strategic Growth, which was up 17.2% last year and will almost always do great whenever stocks suffer. But this other fund, the Federated Hermes Fund, made 22% in 2021. So it truly moves independently of the stock market, of managed futures, of the Hussman Fund, etc. I wanted to get out of treasuries because the inflation scare is probably still just a scare, but long treasuries are highly volatile, and I'm managing the risk level. So once they went down over 4%, I sold them. Keeping just a little because I truly believe in them over a 1-year time frame. And then the main thing we have now is these managed futures. I added to them. I added to this one on top that is up 5.26% from February 1st. And the Campbell Fund is up 7.32% since February 1st. So wow. That's 50% of our money, 26% now. So that's 75% in managed futures and equity long short, almost certain to do either really well or a lot better than that in any severe market downturn. The broader the downturn, the more those should make And that's 75% of what we own. The rest is mostly in treasury bonds. Over the next, and ours aren't even very long. Most of them are 3-month loan, actually corporate debt, 3-month. And then we got some 4-year and some 19-year treasuries. We might cut back further on those. I hope not, because eventually I think they'll end up going up a lot. Right now, my tactical allocation says I need to be unusually active. Okay, so I'm going to change our accounts in up to 1 day. Okay, if let's say big risk hit tomorrow, big risk. And I looked at everything in our accounts. There's like 10 things we own in the tactical allocation portfolio. If 7 of them on that day went up a lot and 3 of them went down a lot, I would sell those 3 the next day. In other words, no questions asked, because there's no long-term concerns in a scenario like that. All the correlations are either +1 or -1. And if you're on the wrong side, and that turns out to be the beginning, not the end, and it continues, I mean, who knows how big the losses can end up being by being patient. So when it comes to periods where it really gets volatile and risk hits hard, you want to be the first one, ideally, to get completely out of the way, 100%. And that's what I intended. That's what I'll do. Now I go into that expecting that everything we currently have is probably going to go way up, but I don't know that. I am fairly sure 7 out of 10 will go way up, but I'm not sure. And the ones that go down, I doubt if they go down too much. But those would be mostly the bond funds, and I'm not convinced they'll go down. They could go way up. Treasuries could roar in the next serious risk episode, which could be any time. But these do remain strange times. And if my thesis from this last month's report is correct, that our big problems will probably eventually emerge in the shadow banking system, it's 42 or so trillion dollars of assets, then we'll never know where it's going to come from until it starts blowing up in our face.
Well, I would say that the idea of being able to move your investments and your asset class choices, there's never been a better time to do that. To be able to get out of the way of certain things that may occur quickly.
I mean, this is like the most certain thing ever. The Fed, that everybody thought had their back all the time, and you got to trust them. Well, okay, they're driving us towards a wall consciously, because they know if it's between that and inflation, if you're a Fed, you better choose the wall.
Their fiduciary responsibility,
They've
which
got
they have, which we've given them that power, they really can't do anything else right now.
No, until the inflation is gone, they have to keep driving straight at the wall, and they know they're going to hit it. Now they pretend it's got cushions all around it, and it's going to just be like falling into a bed of, feathers. But they know we're going to hit a wall.
Very good. Well, I think this is helpful in giving a lot of context to the portfolio and the rationale at the moment and the rationale going forward, to respond to what happens. And, there may have never been a time that we've had so much uncertainty out there as far as the things that drive markets and economy. It's just kind of endless right now, the possibilities.
And so we're going to stay ready to act very quickly. until that uncertainty is cleared, until this time period, until the risks have blown over. Until then, I'm ready to act now. We'll be patient later. As you know, as soon as there's bargains, we can buy things in bargains and patiently wait for them to appreciate in value over time, et cetera, et cetera. But for right now, no patience, not with moving money around. It needs to be diligently taken care of because big weird things can happen with money right now. Okay, markets could go all sorts of dangerous directions, and you never know for sure until it's happening exactly which ones are going to be going in which direction. That's why I have my 1 day approach. 1 day, and I'll change it. And I'll be positioned. I think I'm properly positioned now. I know I will be the first day risk really hits. By the second day, we'll be like fully ready.
Okay. Well, gosh, Richard, make sure you get some sleep. Sounds like you're going to be awake a lot watching the ticker.
One of these days, I hope that it gets exciting enough that I'm watching it all night. Yeah. I know we'll be making a lot of money, but I know a lot of people will be losing a lot of money, but it'll be exciting anyway.